Okay, well, why don't we get started with some brief introductions. Welcome to this webinar on U.S. economic fallout and policy responses. I'm E Janow, Dean of the School of International and Public Affairs, and it's my enormous pleasure to be moderating this conversation with three outstanding experts. It's a great pleasure to collaborate with Glenn Hubbard, Dean Emeritus and the Russell Carson Professor of Finance and Economics at Columbia Business School. Glenn has had a remarkable career that has spanned academia and, of course, leadership positions in government. He served as chairman of the Council of Economic Advisors, an extraordinary author of many articles and books in economics and finance, as well as serving in leadership positions in corporate boards and other organizations. Also with us is Professor Jack Lew, who's we also think of as our professor. He joined us after serving as the 76th Secretary of the Treasury, and is a visiting professor at SIPA. Professor Lew has had an extraordinary career in serving in Congress, in the executive branch, in academia, and in the corporate sector. Prior to being Secretary of the Treasury, he was White House Chief of Staff. He served twice as Director of the Office of Management and Budget. Earlier in his career, he served in senior executive roles at Citigroup. He was also a senior official at NYU University, and earlier in his career served in the Congress, working for the House Speaker, Thomas O'Neill. Thank you very much for being with us, Jack. It's an enormous pleasure to have you here. And he's also teaching an extraordinary seminar at SIPA that's we greatly appreciate. Also with us is Professor Trish Moser, who is Director of SIPA's program in Advanced Economic Policy Management, and who leads our school's initiative on central banking and financial policy. Previously, she was head of the Office of Research and Analysis at the U.S. Treasury Department, but a great bulk of her career, some 20 years, she served at the Federal Reserve Bank of New York, where she was a senior manager at the Fed's open market desk, overseeing market analysis, monetary policy implementation, and she was at the Fed during the great financial crisis in some important roles. So we have with us three extraordinary individuals, and I'm very much looking forward to this conversation on the US economy and perhaps a little bit on global economy. So let me invite you first, frame a first question. We're obviously living in one of the largest economic contractions of the US and the global economy in 80 years. It's happened with unprecedented speed and severity since March as a result of the COVID-19 pandemic. The job gains of the last decade have been lost. We have maybe 30 million unemployed. And the effects of this crisis are really enormous. It's been characterized by economists as both a demand and a supply shock to the US and the world, which makes it particularly difficult to design policy interventions. Yet, the Congress, the executive branch, and the Fed, with great rapidity, have introduced a variety of measures, some 3 packages, amounting to nearly $3 trillion, and it appears that the instruments chosen, some of which we have not seen before, and have been aimed at providing income supports to individuals, bridge financing to small and larger businesses, equity infusions, and massive liquidity infusions to keep credit and markets flowing. So I guess the first question I'd like to ask each of you is, how do you assess the measures that have been taken, both fiscal and monetary? Do they feel like the right objectives? Are they working to achieve their stated objectives? And given the magnitude of the pain being experienced in the US, are they enough? So may I invite Secretary Liu to comment first.
Thank you very much, Merritt, and it's good to be here with you all today. I think in assessing the response, we have to really embrace the unique challenge and the fact that it's not like anything any of us have ever confronted before. This was not a financial crisis or an economic crisis that grew organically. It was a crisis that came because of the health crisis, and everything that we had to do to respond and that we need to do going forward has to reflect that reality. I think the first and most fundamental challenge was to understand the enormity of what we were dealing with. Shutting the economy down is not something that anyone had ever anticipated having a response mechanism to. There was a very real risk that if things were just going to go without any policy intervention, that this could become a lasting depression. And that was the challenge policymakers faced with really, while there was a bit of warning in that you could say we should have known from December or January on, it wasn't years of preparation for something of this magnitude. I'm going to say a few words about something that Trish, I'm sure, will talk at more length about. The Fed jumped in aggressively, quickly, using all the tools that they had, I think quite appropriately. Whether they needed to go to near zero interest rates as quickly as they did or not, what they were signaling was we're going to use the tools we have, but we need more tools. They stepped in and they made sure, from my outside perspective, what I think they did was they said, what do we do to make sure this doesn't metastasize into a financial crisis? And how do we maximize the possibility that you can turn the lights on when it's over? And I think we can get into more detail, but I think that they've used the tools they had before and the new tools they're being given quite well. I think Congress and the administration responded in a situation where, I can say, looking at my own career of almost 30 years in government, I would always ask, how do we get this as close to right as possible? How do we thread the needle to avoid unintended consequences, unjust enrichment, things being not the way you meant them to be? I have to tell you, the advice I was giving policymakers 6 and 8 weeks ago was, you don't have time to get this perfect. If you don't move quickly, the human pain and the economic pain will be potentially irreparable, and you can come back and clean up mistakes afterwards. Come back if people commit fraud, but don't tie the hands of intermediaries so they can't get money out there. And I think there's some Monday morning quarterbacking going on right now, where if you had more time, of course you would have done things differently, but the performance has to be measured against that challenge of moving quickly. Where do I think there are some gaps? I think the time frame that we're going to need assistance is far longer than the duration of the health crisis. The economic recovery, and we can get into what we think the shape of it will be, is almost certainly going to lag what is an initial health recovery. I think the economy is going to need help. Individuals with unemployment are going to need help. Businesses are going to be cash strapped, and the needs won't end when the lights start going back on. I think the political environment will not permit round after round. And I think it's incumbent on Congress to get it right this next time, looking ahead into the next phase. The second thing I would say is they have given some support to state and local governments, but that I think is going to be the battleground in this next political fight, because states are standing to lose $300 to $600 billion of revenue at a time when their costs are skyrocketing. And at the worst possible moment, we could see layoffs in vital services. And we can get into discussions as to whether states need to do other things to clean up their pre-existing fiscal challenges. What they're dealing with now is a crisis that can only be addressed if there's federal support. So there's a host of details they could go into. I would say the speed, they get a good mark on. The coverage, they got a lot of the things they needed, not everything. Fine tuning, now is the time to think about how do you fix some things with a little bit more time.
Thank you very much. May I invite Glenn, your thoughts, please?
Thanks, and thanks, Merritt, again for having me. I think Jack put out exactly the right themes for how to think about this. There are two things that are different from the '08 financial crisis. One is that was a crisis that started in the financial sector and bled over into the real economy. This is going the other way. And the real economy didn't, as Jack put it, didn't organically think of this. This came about because of a health crisis. That's difference one. Difference two is speed. In '08, both the Federal Reserve and the government were a little slow to act to something that was unfamiliar. Here, because of a new toolkit, because of ways of thinking, the action has been much faster. To the measures themselves, of course, whether they're good or bad depends on the problem you're trying to solve. When I first met with some congressional leaders on this matter, they had in mind that a shutdown was like a light switch that went on and off and you didn't need very much help. I said I thought that was exactly wrong. And it basically, what a shutdown is a supply shock that would close large sectors of the economy, very different from any recession that we've lived through in the modern period. And the right way to think about a policy response isn't stimulus in an environment like that. What are you stimulating? We're all at home, but rather simulating relationships that would have gone on in a normal economy. That's the continuity of businesses, the employment relationship. The last thing we want to do is have this as an environment where millions of businesses, tens of millions of workers in many states simply go into financial distress and lose valuable relationships, so that when we reopen the economy, not much is there. We want to avoid that. So with that in mind, what do you do? Thinking from the government's perspective, to preserve business relationships for very large firms, it's a matter of trying to assist firms that are very interconnected in an economic way, much like we talked about financial interconnections in the financial crisis. To do that, of course, for very big firms, the Treasury does need to retain some upside in the future. We shouldn't be simply handing out taxpayer money to very large firms. For small firms, we need to keep the relationships intact. We need to keep them going. We need to keep employment done. As part of what was called the CARES Act, the Congress did pass a paycheck protection program, which, while not exactly what I and others recommended to them, did at least have as a feature giving grants conditional on keeping employees. And I think that's going to be very, very important. The implementation of that program has been slow. As Jack suggested, sometimes we had people who were trying to make the best the enemy of the good, and we frustrated a lot of lenders and borrowers. While I give the Congress marks for speed, I do not give the Treasury or the SBA, the Small Business Administration, very good marks for getting the program off the ground. It's getting better, but we need to do more. To the Federal Reserve, the Fed was very active. Fed 1.0, which is traditional lender of last resort lending in the Treasury markets, was very important to keep markets functioning. Treasury, or Federal Reserve 2.0, which was trying to buy up debt that was investment grade to keep the healthiest sectors of the economy liquid, I think was also important. Fed 3.0 went into fallen angels, one type of non-investment grade debt, and state and local debt. That is not traditional central banking. That looks a little bit like fiscal policy. But of course, the Fed did have the explicit blessing of the Treasury and the government to do that. Fed 4.0 is on the boards right now, which is the so-called Main Street lending facility. I think it's very important. We could get back into this later probably, but I think it's not being set up in a way that's likely to be successful. And again, I think the Treasury may be more at fault there than the Fed itself. The shape of this cycle to me looks like a Nike swoosh, meaning it's a sharp downturn and a checkmark upturn. And that upturn is dependent both on health recovery, but it is also dependent on the shape of policy. And I think what we're going to be pivoting to soon, and I guess we can come back to, are the next round of policies. As Jack was suggesting, how do you segue from shutdown to a normal economy? That's not going to be a light switch. It's going to take some while. Firms and individuals are going to need help, and we need to get that right. So I would leave it there.
Thank you. Those are wonderful and wide-ranging, and we'll pick up on a few of those. But Let me invite Trish Moser to bear down a bit more on the monetary policy dimension, if you would. And, what's your assessment of the measures taken and how unusual are they? I mean, from a Fed perspective, and how are they being deployed in your view?
So everything about this crisis is absolutely extraordinary, including the way the central bank has responded. But that, as Glenn pointed out, that's the nature of this. The economy stepped off a cliff. That doesn't happen. The economy is the slow part. The financial markets are usually the part that move quickly. Even by Federal Reserve standards, they tend to be a bit faster than other parts of the government in policy responses. But this crisis is faster than even that. So what the Fed has done is quite extraordinary. It's very vast. I want to point out that they have put in place or announced or have almost put in place more programs in 6 weeks than they did in more than a year during the financial crisis. Not only that, they announced most of those and implemented many of them implemented half of them in 8 days. 8 days. Which is absolutely beyond extraordinary. 3 categories, I would break them down. Glenn mentioned them earlier. They have done monetary policy. In other words, to ease monetary policy to make financial conditions easier so that the bridge financing, if you like, that the private sector needs to do for itself is less expensive. They have done traditional lender of last resort, liquidity provision to the financial system. That again is to forestall any sorts of financial feedback flows that could be negative. The real economy is weak enough. It doesn't need a negative financial feedback loop like a financial crisis to make it even weaker. And last and not least is this very targeted credit lending set of programs for businesses and for households and for state and local governments that is being done and planned on a scale that is completely unprecedented, as far as I can tell. Just to give you an idea of the sizes, the monetary policy part of this, the Fed cut rates to 0 immediately started asset purchase programs to lower long-term interest rates, which are even more important for borrowing by households and firms. They have been massive. For about a week in March, because of financial market turmoil, they bought more securities in a day than they bought in any month during the financial crisis. In 6 or 7 weeks, in another week or so, they will have bought as many securities as they bought in 2.5 years of QE1 and QE2, and they will have done it in about 7 weeks. So the degree of monetary easing in the traditional sense has been huge. Interestingly enough, though, the liquidity provision, the traditional lender of last resort, has actually been pretty small, with one exception. And the reason is, of course, is the financial system and the banking system was pretty healthy walking into this crisis. It's weird in a crisis like this when, relatively speaking, finance is a source of strength, but for the moment, that's the case. They actually don't need the liquidity at this point. But, and this is a major but, as this real economy crisis gets worse, as firms begin to go bankrupt, as households and businesses start to default on their loans and their financial obligations, the financial system, which looks strong today, could end up being very weak, particularly if we don't put some sort of a floor on income and job losses and business destruction. So I completely agree with both Glenn and Jack that that's incredibly important. What you really, really don't want that, because that could lead a financial crisis on top of this real economy crisis, could basically make an already fragile economy in even worse shape. Final point, the credit programs are potentially enormous, as big as $4.5 trillion if they were at their maximum size, but they are complicated and brand new. And those things take time to plan and time to execute. A few of them have been implemented and are being used, but most are still on the drawing board. Even the corporate credit programs are probably only going to start, I'm guessing, in the next week or so. The Main Street facilities, the lending to small and medium-sized businesses, they are basically for the 3rd time ever revised. And so those programs are yet to come. And this is what worries me personally, because as both Glenn and Jack have said, speed matters immensely. These programs are designed to be bridge financing for the real economy pretty directly. And they require, and they rely, indeed they couldn't be done if Congress had not allocated effectively a backstop, a taxpayer backstop for the Federal Reserve to do the lending. So there, time will tell. But I'll repeat what Jack said earlier. This is a case where one can't let the perfect be the enemy of the good. The sooner those get going, the better.
So let me get back to that point and invite Jack, if I may, to pick up on your point about the states, and perhaps frame it in remembering in the great financial crisis, when the ECB chair Mario Draghi said that he would do whatever it takes, it offered a certain comfort to financial markets. And ask ourselves now, when we think about what more is needed, what's our scope for further action and what are our limitations? Is it a political economy challenge of getting because now it's getting more difficult politically to design that fourth package in a way that would be offering meaningful support to states and municipalities? Or is it a balance sheet challenge that, there are fundamentally different views on what the Fed balance sheet can withstand? How do you think about our ability to do whatever it takes?
So, I've thought over the last couple of days that Mario Draghi got all the benefit of saying he would do what it takes, but never actually had to do it. And now Christine Lagarde is going to actually be the one who has to show whether it works. So I am watching closely, and I certainly have confidence and hope that she will be able to deliver. I think if you look at the United States, I don't want to be cavalier about spending $3 trillion. When I was OMB director, that was the entirety of the federal government. So this is a lot of money. Our debt is going to go to 100% of GDP, our publicly held debt, probably this year or next. Well, that's a 25% increase. It's a big, big amount of spending. With that said, I think if we hadn't done what we've done, and if we don't do what is required for the next step, the pain that we will suffer in terms of economic loss will flow through in terms of lower revenue, and we'll probably see the deficit go up more, not less. So I think if you just think about macro fiscal tools, this is the moment to not be worried about spending a little too much. Do we have to stop as soon as we can? Yes. The question is, when can you stop? I would argue, and the point Trish just made, and the point that Glenn made really reinforce this. If we stop, while unemployment is still very high and the economy is growing very slowly or barely at all, we're going to regret it. My own experience in 2011, 2012, yes, we needed to worry about fiscal policy, but we started tightening the screws on short-term spending, and we slowed the recovery down. We don't want to do that now. The stakes are much higher now because of the highly volatile situation. And what we can't afford is running the risk of the kind of liquidity crisis, the kind of financial crisis that would test our ability to respond. So I think as a just fiscal policy matter, we do have the room. I don't know if the right number is ultimately 4 trillion or 5 trillion. But I'm not scared if the number is 4 trillion or 5 trillion. And I think the political economy question is actually the more significant one. For example, the question about when do we start worrying about the deficit is being raised now in a political context. It's being raised in the context of what states do you bail out, and do you look at whether the governor of the state is from one party or another? That should be irrelevant. I don't care if you're from Ohio and Louisiana with Republican governors, or from Michigan and New York with Democratic governors. If you're in a crisis, you need the help, and you need it now. If we end up waiting until September or October to do that, the states will start making the cuts, and we're going to feel the pain of that in terms of services and economic activity. I think that if you look at the experience from the Great Recession and the response to it, The states that got more fiscal relief actually did better coming out of the recovery. So there is even some data, not vast historical data, but a data point in the last 10 years. Now, I know there are a lot of questions being raised about whether or not states have dug their own holes with pensions that are unfunded and things like that. I'd say those issues are off to the side right now. No state is making new pension commitments now. This isn't the time they're going to solve them. The question is, over the next year, 18 months, can we support a part of the economy that should be part of the solution, not become part of the problem? So that's the case that I would make. The political economy is we're in an election year. We're in a year when the color of the party matters more than it normally does. And it always matters some. I hope we can get beyond that. You know, I've spent a lot of time over the last 6 weeks directly and indirectly consulting with Republican governors who share the kinds of concerns. I think there are other issues. I don't mean to say state and local is the only one. I mean, if I were going to put another issue up there, making sure unemployment insurance is available. There's been a lot of debate about, is the bump up of $600 too much, and is it creating a disincentive to work? I wouldn't be distracted by what the bump up should be. If that needs to be adjusted, adjust it down. But don't have people run out of money to pay their bills. A, it's a humanitarian problem, but B, it's a macroeconomic problem. You don't want a demand crisis on top of everything else right now.
Thank you very much. Let me invite Glenn, if you would comment on what you think is our scope for further action, and maybe also lead us into a little bit of a discussion that you were signaling about what the risks are in the system that we need to be worried about.
Well, I certainly agree with Jack's comments about fiscal flexibility. The United States is in a uniquely blessed position among countries as a reserve currency country. We shouldn't trifle with it, but we have the opportunity to do a large amount of one-time borrowing effectively to fight a war. We did that in World War II, where we also pushed our debt to GDP ratio above 100%. And we stopped fighting World War II and we grew. For one-time changes in borrowing, that's how it should work. The nation has plenty of other fiscal challenges that aren't one-time challenges, but this one is. And the goal, as Jack suggested, is to get it right. If we spend too little or spend things in the wrong way, we risk digging a very, very deep hole. So we have the scope to act. Where is the action needed? I too would start with state and local governments. The same argument I made before about not wanting employment relationships and service relationships to be severed, and hence helping small businesses that are a lot of output and a lot of employment. Same argument applies to states. There are a number of proposals for aid to states. Some from the National Governors Association would be through block grant mechanisms. Others would be through changes in the matching for the Medicaid program, a program largely for low-income Americans whose costs are shared by state and federal government, so making the federal share larger. Obviously, support for public health infrastructure that's lacking. And we know there are externalities there. A sick person in one state can also go to another state. So we need to get this right at the federal level. But I think we're also going to need support in the interim, again, for households and for businesses. This could come through traditional unemployment insurance. It could come through a program called short-term compensation, which is part of the unemployment insurance system, at least in about half of the American states, but would mimic some European experiments of trying to transfer funds to keep people on the job, and then maybe phase down versions of the Paycheck Protection Program. Both Democrats and Republicans in the Congress have talked about that. The pension issues in the states should not derail us. They are significant, and they are the opportunity down the road for Congress to do old-fashioned horse trading, meaning we won't give additional further support to states, say through increasing block grants in the future, without pension reforms that look more like the private sector. Congress could talk about the tax exemption for state and local debt. There are lots of things to talk about. This crisis is not the time for that discussion, and adding the prospect of state bankruptcies on top of a lot of business bankruptcies is distinctly less than helpful. If we don't get this right, we're going to get a doom loop. We may have started with a supply shock, but we will get an aggregate demand doom loop. The Fed and the government are doing a lot to get ahead of that. And don't let politics distract us from finishing the job that's in front of us.
Thank you. Trish, let me invite you to just offer a further comment, though, about banks. I mean, the major banks are now well capitalized coming out of the last crises. And as you said, the worry has been around liquidity, not solvency. But as more companies need capital, depending on how long this goes, how concerned are you about liquidity concerns, turning into solvency concerns that could affect banks? And, other times we've seen this crises and stress produce bank mergers and other consolidation restructuring. Is that on your mind as well, or is that not a concern?
So yes, it certainly is. If you don't mind, I'd like to make one very small comment in response to Glenn and Jack's comments about state and local government support, which I largely agree with him. I do want to point out that state and local government support, fiscal risk sharing, there's a reason they call it fiscal risk sharing. It's a fiscal policy responsibility. Now, the Federal Reserve is introducing one facility. It's not operational yet, but presumably it will be fairly soon, to lend to states and to large local governments against future revenue, against future tax revenue. So again, providing bridge financing. Again, with a Treasury backstop, meaning using taxpayer backstop from the legislation. I have to hope personally that the bulk of the assistance to state and local governments remains a fiscal responsibility. Doing large-scale amounts of lending by the central bank, if you like picking winners and losers among states and municipalities, puts the central bank first in a very awkward position from a political economy standpoint. And frankly, it's a bit of an abrogation of fiscal policy responsibility. So I simply want to make that comment in response to those. There's the role for the Fed here is limited and should be limited. So regarding the banks, yes, as I said earlier, and both Jack and Glenn have said, if the real economy does not get the kind of support, the sort of income supports for households, the sorts of business supports to keep people either employed or with appropriate unemployment insurance, then the default rates, the degree of financial distress that not just the banks, but the entire financial system could face in 6 months from now could be enormous. And although they're incredibly well capitalized, largely because of the reforms after the financial crisis, there is only so much pain that any leveraged financial institution can take. And at that point, if they start to conserve credit, banks have increased their lending dramatically in the last 4 to 6 weeks. But if they start to curtail that dramatically instead, then you get into a financial, sort of doom loop of the type that we had 12 years ago. That starts with liquidity, and certainly the Federal Reserve can provide liquidity. But if it's truly defaults and solvency, then that's not something that the Federal Reserve can fix, and you end up with an even bigger potentially economic hole, real economy hole, and more unemployment and more bankruptcies than you had before. That worries me. That worries me a lot, and is all the more reason that you ought to front load it. Could you have bank mergers coming out of this? I think it's possible. Certainly, there are certain types of banks, particularly the smaller banks, who could merge. There's really no appetite to do that, and one of the reasons everybody wants to stay away from the financial crisis part of this is we don't need the core of the financial system to be any more concentrated than it already is, frankly. So I would hope not, but it's certainly a risk.
So let me ask Glenn to shift us a little bit to understand a puzzle of this moment, which is what appears to be something of a disconnect between, the severity of the crisis and its impact on the real economy and the way that capital markets are behaving, which has, rebounded dramatically, or at least more than half since, middle of March 23rd or so. You know, and volatility has also come down. Why are financial markets recovering this quickly and appear this optimistic? I mean, do you think it's because how other countries have been handling the pandemic, or confidence in US policy responses, or, you know, are markets simply failing to recognize the risks? How do you think about this?
Well, it's a great question. And if I had a fantastic answer, I'd be a billionaire hedge fund investor instead of a professor. But I'll give you the way I think about it as an economist. One possibility, and it's the possibility news media talks about, is just that there's too much optimism in the stock market. They don't get it. I don't really think that's what's going on. It may be that market participants are using a very tight confidence bound about the availability of vaccines or about confidence in policy. But I think it's really more about two things. One is something we've been talking about, which is huge central bank action that has taken off the table a left tail financial outcome that one might have feared, absent the Federal Reserve's intervention. So there are not going to be market microstructure problems. Discount rates are going to remain low. Those are all very positive for equities. The second thing to remember is the stock market's not the economy. So we talked earlier about the small and mid-sized business sector and the efforts there. Most conventional stock market indexes that probably most people watching this webinar look at, like the S&P 500 or the Dow Jones Industrial Average, are heavily concentrated into very large companies, many of which are in the tech sector. So those companies are actually doing quite well. And in fact, there could be, we talked about just a moment ago, a trend toward bigness in banks. This crisis could well produce more bigness in the real economy. Think restaurant chains substituting for small restaurants. Think further consolidation in technology and in healthcare. Those are good for equity markets. Whether they're in the long run good for the economy is another story. So I don't think the divergence is just about excessive optimism. I think the stock market is processing some things. It's just not all the future health of the US economy.
We're going to open up for Q&A from those who are attending in about 10 minutes. So if you have questions, please submit them in the Q&A function, and we'll turn back to you in a few minutes. But let me invite Jack. Would you care to comment as well on this seeming divergence between markets and the economy?
As a policymaker, I must say I tried not to be too distracted by the ups and downs in the markets, because they tended to move more quickly than the real world, and in response to things that you could only kind of hypothesize as to why. I think that I agree with Glenn that the quick response and the so far effective response to contain the crisis so that it is not a financial or a systemic crisis is a source of some optimism. But the reason we're talking about small business as much as we are is because half of the jobs in this country are in small businesses. If that part of the economy is devastated, new starts will take a long time to come on. And even if Glenn is right that they're replaced by larger firms, whether that's good or bad, that takes some time. So you're going to just stretch out the recovery. So if you're thinking that this is going to be a kind of gentle U recovery, it becomes a less gentle U, and you don't want it to become an L. And not to oversimplify it, we're trying to, policymakers are trying to navigate in that space. And I think the market is so far giving them kind of a good grade for the effort. That could change very quickly if it becomes clear that things aren't working. And if I could just comment on something Trish said, because I totally agree with her about the Fed not being the ideal mechanism for delivering subsidies. I give them some credit for working out this relationship between the Exchange Stabilization Fund and Treasury and the Fed to provide an ability to use a channel that exists, even if it's new and untested, because one of the problems is we don't have that many channels in our government to respond quickly. Coming out of this crisis, one of the after action things we have to do is ask, what do we need as a modern 21st century economy and government? What tools do we need to be able to more quickly get money to individuals or businesses with some degree of sophistication? I can't tell you how primitive the current tools are. I mean, Glenn and I could bore everyone with the struggles we go through as policymakers trying to use those tools to do things they weren't meant for. I have a great deal of empathy for policymakers struggling with imperfect tools using the ones they have. That's not to say we shouldn't improve the tools. And I think that's something that at a school like ours, we'd be kind of doing a public service, putting more thought into.
Mhm. Thank you. Trish, would you care to comment on this? And particularly, maybe you could lead us a little bit into, I mean, I think Glenn has already given us a hint that he thinks the recovery will be like a Nike swoosh. I'd like you to go back to that if you would, Glenn. And I think Jack has suggested that there's a vision that he's worried about it could take the shape of. What is your sense of the path forward?
Yeah, so one very short comment about what Jack said about the workings of the government, broadly defined here, because obviously, particularly with respect to these credit lending programs that are just getting started, and presumably we'll see a lot more of in the coming weeks, that the Federal Reserve is working on, they're clearly quasi-fiscal. The Federal Reserve could not do those programs on their own. They are too risky. It's frankly illegal for the Fed to do that without having a taxpayer backstop, without coordination with the fiscal authority. What the Fed has in some respects is a bit more speed, but notice if the Fed is the speedy one, it's still been going on for a number of weeks before they've been able to get this up and going. I agree with him that the tools are creaky. Even the central bank tools, while slightly less creaky, perhaps than the fiscal policy tools, are creaky. And some serious thought, I think, by people at this school, as well as the government more broadly, about when do you need that tight coordination between a central bank and the fiscal authority, and when you don't. And how do you keep them separate in normal times, and how do you coordinate effectively in real extremis in a way where the rules and the boundaries are very clear, would be immensely helpful. I also think it would probably cut down on the communication confusion quite a bit, which always helps in a crisis. Being very clear about who's going to do what and when is one of the most important things that you can do in crisis management.
So let's leave that second question to Glenn. But on this one, do you see the Fed and Treasury working as one at this moment?
It's actually, it's not that simple. For example, the $450 billion that Congress appropriated and gave to Treasury to backstop Federal Reserve credit facilities, to provide, if you like, an equity cushion, is completely in the control of the Treasury Department. The Federal Reserve does not allocate those funds at all. So how the lending structures get put together is a joint decision, but which ones get the capital, which ones get the backstop, and they're where the Fed has the potential at least to lend a lot versus a little, it's completely controlled by the Treasury. It's not their call. And how much risk is taken? I think Chair Powell and the Secretary have been pretty clear in the last week that the decisions about how much risk can be taken with that those taxpayer dollars is completely controlled by Treasury. How the facilities are designed, that is clearly a joint decision, and it's a cooperative one, it seems, by all reports, because the Fed does indeed have a very large, the predominant amount of the lending and the predominant amount that goes out is going to be on the Fed's balance sheet, but the first loss piece, so the biggest losses, if there are losses, will be borne by the taxpayer and the Treasury Department. So those have to be joint decisions. So they're working, I think, much more hand in glove. But the execution itself, when it comes to the actual execution, that execution is completely being done by the Fed. So it's they look like they're working together exactly, but it's a more complicated dynamic. And if things don't go well, those details are going to matter. I'm not hoping for that or wishing for that, quite the opposite. But those details will matter. There's a whole separate question about how it happens when this is done, but maybe we can come back to that later.
Okay. Glenn, may I invite you to comment, if you wish, on this dimension, but also lead us into your assessment, and if I will, I'd like to invite Jack as well, on what kind of recovery trajectory, given the facts we have before us now, and obviously there's so much we don't know about how this pandemic will be, the science and the epidemiological dimension of it will unfold. But I think you've already given us a hint that you think that we can have quite a recovery. But Glenn, I invite you to comment first.
Sure. Going back to something Trish said on the Fed, which I think is incredibly important. The Treasury is in the driver's seat here, and not to get too much in the weeds, but I'm very worried about how these programs are being stood up. Too little capital has been allocated to a Main Street lending facility for it to be effective at all. If one just looked at publicly available data from the stress tests for commercial industrial loan lending to small and mid-sized firms, there is no way that the Fed is really planning to be serious here with that amount of money. In fact, the $1 million loan threshold, which is now 500,000, meant they really weren't doing small business lending at all. So there's going to be huge communication problems, huge political problems. But to echo what I said earlier, really the Treasury has got to be willing to lose some money here. If the notion here is that we're going to repeat the experience of TARP, the Troubled Asset Relief Program, and not lose any money, except for the auto losses that happened there, that's not the lesson to learn from history. And I would invite people to go learn a different one. On the shape, the reason I like a Nike swoosh is, one, I think that's what it will be. And two, as an economist, it gives me some elasticity because I haven't told you exactly what the slope is. I've told you it's a check mark. A V would require me to make more commitment, and so would an L. So I'm giving myself some wiggle room. And the reason I do that is it does depend, as you suggested, a lot on the evolution of public health and science. So will we get a drug that could at least, if not be curative, take the left tail away of extreme hospitalization, intubation, and death? Will we get a vaccine in the period over which Dr. Fauci and others have suggested? Those are clearly important. Public policy, though, is also important. I agree with everything that each person has said today about the role of small and mid-sized business. And if we let a lot of failures happen here, we're not just going to restart these overnight. So policy has to get that right. So if we get it right, I think we can do a swoosh. And the reason that's still a slightly pessimistic statement is I don't see a scenario under which a V is possible. I know in Washington that's still being discussed. I don't see that. To me, the Nike swoosh is the optimistic scenario, and I have that much optimism.
Mm-hmm. So I think, you've made, both of you, Trish and Glenn, have made some really important observations about the relationship between the Fed and the Treasury. Jack, you have a really unique perspective on how that can operate in a crisis. And do you agree with this sense that not enough is being done? It needs to step on the gas?
Yeah, I actually very much agree with the way Glenn characterized it. When I talk about a modest U, it's a swoosh. I don't think there's any chance of a V. I don't see how, when you're talking about getting back at 50 to 70% rates, if you're lucky, you get kind of that instant recovery. I had hoped for it early on, but that was 6 weeks ago, which is like 6 years ago in terms of our understanding of the coronavirus. I mean, this will be driven by the science and the health. And I just don't see how that's possible. I also agree with what Glenn said about Treasury. I guess I'm a little bit charitable towards Treasury on this because of the speed with which they worked. But behind that, are some judgment calls that they will have to learn from the mistakes they made. It's not an accident that the PPP program didn't get to the smallest businesses. There were questions about how much due diligence banks had to do on know your customer requirements. Banks had all the information they needed for their credit customers, but you know what? Main Street businesses don't take loans from commercial banks. So that decision to go first to the bank customers who had loan histories automatically skewed it away from the smallest businesses. Well, you can get around that. There are substitutes for traditional KYC. There's nobody who cares more about stopping money laundering than I do. But if you get a checking account, you go through KYC to get a checking account. For this purpose, that's rough justice for KYC to get into the program. You need to be creative. Second thing, guidance. I thought from the beginning that it was right to tell the banks, you're not responsible if the certifications that businesses make are fraudulent. You need to tell businesses something about what the shape of need and fraud is. Because I think there are businesses that just followed the guidance because their accountant said you're qualified, that are now having to kind of give back the money, and there's, if anything, an overreaction that's likely. They've got to get this right. The idea was give money to businesses to keep them humming, keep workers attached to the workforce, be able to go back. I think, I call this Monday morning quarterbacking. I spoke to a lot of Democratic senators saying there are going to be people getting money out of this that you don't think should get money. That's okay. It's okay if it's like a 10 or 20% problem, you clean it up afterwards if it's criminal or fraudulent. We can't, if it goes to the Fed and the Fed implements its program in a narrow way because of the mistakes made, it will have no impact on the smallest businesses. If it's overly broad and doesn't give a meaningful sense of what's intended, you'll end up with a change of signals afterwards. This is going to require some artfulness that I think does come from Treasury. I would just say one other thing in terms of TARP. I was very proud to be able to say that we got back in the aggregate more money than we put out in TARP. I don't know if that's going to be possible in this case. When you know that businesses are going to fail in large numbers and your goal is to keep that number to a minimum, and you're willing to turn loans into grants in order to accomplish it, you have to assume you're going to lose some money. And having an honest statement of what that is will be better to avoid the public backlash that would come if it seems like a surprise. The problem of moral hazard probably held us back in the financial crisis from doing enough to help homeowners. We were so worried that the good homeowner who paid his bill would resent the bad homeowner who didn't pay their bill, that we didn't do enough to help homeowners, and we're paying the price in terms of the political backlash in both parties.
Thank you very much. We've had quite a few questions come in advance and during this session, and a number of them are international. And so I wouldn't want to leave this conversation without at least a moment of considering international dimensions. So let me just start with a very broad gauge question, which is really about what kind of global coordination you think is possible to help dealing with the international dimensions of this crisis.
First of all, I think the United States has to. This virus is not a domestic issue. It's a global one. And while the global interconnections of are less perhaps than they were maybe just a couple of years ago, the global economy and the global financial system are incredibly intertwined. Let me give a simple example from the central banking world. I mentioned very early on in this webinar that actually the Fed's liquidity provision has been pretty small so far because it hasn't been necessary, but there's one very big exception to that, and that is the swap lines with other central banks. By far the largest piece of the Federal Reserve's lending right now is more than $400 billion, which is being lent for dollars to be used by countries outside, for central banks outside the United States to lend to their local counterparties, their banks and companies. The US dollar is the global benchmark currency. If this crisis gets worse abroad, and I think there's a decent chance that it will, that demand for dollar liquidity is going to go up. The Fed has made very clear that they are going to enable that as much as humanly possible, because not doing so, not only because it's the right thing to do globally, but because even if your mandate, as the Fed's is about the United States, allowing the rest of the world to have a major financial crisis and an even worse economic crisis is only going to make it harder for the US to recover. So there's a very easy case to be made, I think, and I think on many other dimensions of global aid, you could make the same argument.
Jack, what dimensions of this crisis do you think we need to be mindful of from an international lens?
I think we've seen quite a few mistakes made internationally, so we should try and not get into the blame game of who made the worst mistakes, but ask the question, how do you unite the global community to do something that you can't do as one country? You cannot stop the spread of a pandemic just as one country. It takes cooperation, it takes sharing science, it takes sharing supplies and medical treatment. For the last 75 years, the United States has been the leader in that space. The fact that the United States is not the leader in that space now leaves a very unstable global response.
I want to just take a moment to thank our distinguished participants for this extremely illuminating and deep conversation. We've run into a few technical problems, but I think it has not overshadowed what has been a truly important conversation. It's one of the joys of Columbia University to have such deep expert colleagues whose professional lives have spanned academia and public service. On behalf of all of us, let me thank Jack Liu, Glenn Hubbard, and Trish Moser for being with us today and for offering your insights on the US and the global economy. Thank you very much.